Let's also welcome then on board the Vice President and CFO of Cholamandalam Investment and Finance Company. We've got with us Mr. D. Arul Selvan joining in on the show. Mr. Arul Selvan, thank you so much for taking the time out and joining in today. We're speaking after the leadership change regime. Post this regime change that one has seen in leadership, could you throw some light on the vision of the company going forward? Where is it that the key focus for the company lie?
See, Mr. Velan, who has come to lead us now as a chairman, has been here earlier, a few years back, and he just went to the Tube Investments and he's the managing director there. So the vision part is almost similar to what it had been drawn during his period and which we had been carrying on subsequently, and now his back is going to be carried further on similar lines as we move forward into the next decade. So we will be targeting, and we are moving in the right direction to be one of the largest NBFCs, and of course factoring in the regulatory guidances on the way the NBFCs needs to function in when they become large, which is what is the new approach of the regulator. We will look forward to move in that direction, whether it is to be participating in the vehicle finance business, loan against property business, or in the home loan business. We are also evaluating other avenues of growth as we move on, and there will be, we will come back shortly, maybe in the next 6 to 9 months, on our strategies on further, looking at new products and new areas to operate.
That's quite interesting. We are eager to hear the new avenues that you're looking at venturing into. But the main thrust of your business, Mr. Arul Selvan, that's been the CV cycle. And help me understand, what is it that you can tell me about the CV cycle outlook, both light CV as well as medium to high CVs? Is the CV cycle now finally back in full swing? And can we safely say that we are back to pre-COVID levels or the peak levels?
See, the CV cycle had, been actually the CV market by itself is also highly dependent on replacements. The replacement cycle had been deferred already by 2 years. The first one when the axle load norms were changed and there had been a surplus capacity. And subsequently, it had also gone through a deferment of replacements when this BS6 was supposed to be launched, and there had been confusions about whether to buy BS4, BS6. And on top of this COVID has happened. So already the vehicles which are on the road are due for replacement in a large scale. So we are fairly confident that FY22 will see a large scale replacement, assuming the economic offshoots, green shoots we are seeing are coming into play. So certainly we are looking forward to a substantial change in the way the growth will happen in the subsequent years.
Okay. And what about your asset quality? Because that has improved this quarter. Do you think that we are likely to see, this improved asset quality trend continue into the coming quarters? Anything in particular that you've noticed?
See, the asset quality, as a matter of fact, asset quality had, we are confident that we can further improve this as we move on into the next quarter, and more so when we do the FY22. Of course, there will also be a denominator factor playing in if the first part of your question on the asset growth happening in line with the replacement market coming in. But beyond that, we are confident that the earning potential of the customers has been progressively improving as we move forward post-COVID period, and the general behavior of the customer, subsequent to the bureau introductions, etc., have been fairly good, and they are now actually, even some of them are even reluctant to take more advances, even though there were offers for giving the ECGLS scheme, etc. People have been very restrictive in taking loans and wanting to be more clear with their bureau scores, etc., which is a very good trend from a credit perspective. So we are confident both with the earning potential improving for the customers as well as the volumes of the growth going up. Asset qualities will remain robust, and there is enough headroom to improve this further.
So going by what you said, can we assume that your overall credit cost guidance for FY21 will be very strong? What is it that you're looking at? And do you think that we can see your margins as well expand from the current levels?
See, we don't want to comment about margins right now. Yes, we have seen margin improvements, but I think we are at the cusp of the rate cycle turning back on the interest rate front, maybe 2 quarters down or 3 quarters down. So we may see some amount of hardening of interest as we move forward. But margins will be robust. We are having, we are moving, we are changing the mix to high yield products. So we will see margins improving. But generally, we don't like to give any forward-looking statements. So we will while we will improve margins and we will also improve credit cost in the sense of reduce credit costs. Certainly, as compared to either FY20 or FY21, it will certainly be much lower. But I can't give you any exact or even a directional numbers to it.
Okay. In terms of demand trends on the rural side as well, what are those looking like?
Yeah, rural has really picked up. Actually, rural has been, one of the areas which we capitalized during the months following immediately the COVID lockdown opening up, when because of the good monsoons and the good crop, the tractor demand and the light commercial vehicle and the mini light commercial vehicle demands picked up substantially. And we were ready. We had the funding, we had the reach, and we had the underwriting capabilities to do that, and so we had capitalized on this demand, and we see that, and we see that as a positive, and we see that with the continuing good monsoons, the rural demand is going to be better. With the government spend in the rural, the consumption in the rural will go up, which will again spur demand for vehicles, for movement of white goods, movement of FMCG goods, apart from the agri products by themselves. Those things will really keep the demand and the business going robust in these areas.
Okay, so that's on the rural side. How long will the current capital last? And, are you looking at any further capital raising going forward as well?
See, we try to work on a model where our profitability, net of dividends is adequate to fund our growth. If we clock a return on asset of, 3%, and we can comfortably sustain a growth of around 20%. So unless there is very good growth opportunities beyond 20%, or our profitability is getting squeezed because of some reasons, this should be a self-sustaining model. So we will keep evaluating this. Right now, we are quite adequate on capital, and considering that we don't want to predict a very high growth, potential in subsequent years, we need to see. So we will evaluate this. We keep evaluating this, but bringing capital has never been a challenge for us. We can bring capital, and as you would have seen, we have marquee investors wanting to invest in our company, thanks to the group, thanks to the performance of the company. So we are comfortable. We don't see any challenge there.
you so much for joining us, Mr. Arul Selvan. We'll leave it there. Thanks for joining us on that. We're going to take a very quick break. Back in a moment.